Good morning, folks. It's 9 o'clock UK time. I am Kenny Whitelaw-Jones, and welcome to this webinar on the valuation of mining projects. And I'm really delighted to be joined by Dennis Cowan and Carel de Jager. I'll introduce those guys shortly. They're going to be talking for the next kind of 50 minutes about mining projects and valuations. I know that some of you who are joining the webinar today already know about F1F9, know what we're all about, but just for those of you who are new to F1F9, just to introduce us, we're a specialist financial modeling consultancy and trading company. We have 50 financial modelers, and we work across numerous sectors, including mining. And we also run training courses around the world. You can find out more about all of that at our website, f1f9.com. So that is the F1F9 plug over with. I'm not going to do any more F1F9 promo because you're not here to hear about that. You're here to hear about mining projects and especially how to correctly value mining projects. And so what I'm going to do is hand over to the two experts who we have here today from joining us from Johannesburg. I am sadly in the kind of 4 degrees Celsius and rain in the southwest of England, and those guys are in 24 degrees and beautiful weather in Johannesburg. So I'm a little bit envious of that. But who we have today, we have Carel de Jager. Carel's a mining economist. He has 42 years experience across the whole of the mining chain, and he's done been involved in over 500 projects. So obviously knows a thing or two about mining. He's previously been head of mining economics at Anglo American, and is currently chair of a group of consultants called Valuation Excellence. And Carel was recently appointed as a topic specialist in mining and mineral economics at the University of Pretoria. So Carel, we're very, very happy to have you with us today. Thank you for joining. We also have Dennis Cowan, an engineer. He has over 30 years of technical and valuation experience in the mining sector. Dennis is one of our team at F1F9. He's leading the development of the mining business at F1F9 and also involved in a number of different consulting projects for a range of clients in the mining sector. So look, I'm not going to talk for too much longer. I want to get really into the topic. But just to say, we obviously want lots of questions. These guys have got a lot to tell you today, but there's also the opportunity to ask lots of questions. So here's how you can do that. And because we're using Google Hangouts, there's like 50 different channels through which questions can come. There's a Q&A page, a Q&A kind of panel on the Google Hangout itself. So I think you press a little button on the left, the panel comes up, you can type your question in. This is also hosted on a Google Plus page, and you can ask questions there. We're monitoring that as well. This is also being broadcast live on YouTube, so you can add a question there if that's where you're watching this from, and you can tweet your question to @F1F9. All of those 4 channels we'll be monitoring, and we'll get questions to the guys at the end. We'll probably let them present and not interrupt because I know they have a lot of stuff they want to share with you today, and then I'll bring some of the questions together at the end. So we may run a bit past the hour with time we get all the questions, because if we've got good questions coming in, we're going to want to deal with them. Dennis and Carel are going to talk for around 45-50 minutes, and then we'll kick off with the questions. So look, my job here is easy today because all I have to do is introduce these guys, and so I'm done, and I hand over to our experts to talk about mining and valuation methodologies. So Dennis, over to you.
Great. Thanks very much, Kenny. Good to be here and good to be with the audience. Very broad range of delegates we have here, so hopefully we'll give some insight and interest to just about everybody. Today we're going to discuss how to correctly value mining projects, and it's not just mining projects. We're going to talk about the entire value chain. So we're going to start from exploration right through the project development cycle and up to operations. We're not going to touch on operational valuation. That's more of a more specialized topic, or a different topic to what we're going to be talking about. So, and with me, I've got Carel de Jager, who I've worked on and off for over the last 20 years. He's one of the most interesting and knowledgeable mining valuators that I've ever met, and he certainly has got some fantastic ideas about valuation. So, Carel, welcome.
Thank you very much. The word interesting, I'm not so sure I like that very much, and what your interpretation is. So we promise not to give each other a hard time today, like we normally do, eh?
Yep.
Please. Okay. Okay, Dennis, could you start the ball rolling? I mean, you were talking about the early stages resources.
That's right.
The first ways of evaluating a project.
Yeah.
Please give us a bit of background around that.
Sure. I think what I'm going to have to do is sort of broaden, first of all, a bit to what I mean by value chain. And I'm going to bring up a slide, and this is from a competent person's report of VALMIN Rand that they did a while back and published. And what we have here is the value chain of a mining project. Starting off at the top, we have exploration along the top, mineral exploration, prospect evaluation, mine construction, and mine production. And those 4 areas, and a project is a lot more complicated than just those 4 areas, and a lot of iteration happens, but those 4 areas are the key areas of a project. And what we have in a mining development project, over time, we're trying to increase the confidence of the knowledge that we have, and as we're increasing the confidence, we are hopefully increasing what we are here for, and that is the value of the project. So when we start at the beginning of a project, down at the bottom, we're in an exploration discovery phase, and we may do a couple of scoping studies, and there are ways that one can value the resource at that point. That moves through to a feasibility stage, which is quite a formal stage with most of the stock exchanges, that a feasibility or a pre-feasibility is the basis of raising capital or raising debt, and through construction and project commissioning. At each of these stages or through that development, we're developing the ore body, and that is the middle section over here, and that is the resources of the ore body and the reserves of the ore body. And that's what we are attempting to get a handle on and put a value on.
Okay, Dennis, I think you need to explain the terminology resources to us, because I'm sure there's some guys who are not involved with mining. I must say I like this graph. I wish I drew it.
Well, I've credited VALMIN Rand. Yeah. It is a graph of VALMIN Rand.
I would probably change it ever so slightly. At the first component, when you only start, sometimes ignorance is bliss. And then you might actually attribute a higher value to the ore body until you find out that there's a couple of warts in this ore body. So that curve might look ever so slightly different. And there's 2 components to this as well, which I think we must just make clear for everybody is this curve more or less suggests what price you will sell the asset for if you've got it. If it's a good asset, in the beginning you don't have information, so information costs a lot of money. So in the earlier phases there will be a lower value, and as the project becomes more mature and you know exactly what you're going to do, there's a higher value. That's how some people make their living, is actually to upgrade that information around that ore body. The NPV attributed to that ore body might actually look a little bit different, so not to be confused. Normally the NPV often starts very high in the early phases of a project, and then the dream becomes a bit of a nightmare as you understand a little bit more about the ore body. Okay?
Yeah.
So with that in mind, Dennis, could you just explain to the guys what this resource thing is that we're putting value to?
Yeah, and we will certainly get back to how value may decrease through the development of an ore body. A resource is the fundamental raw material of a mine. It's the ore under the ground. Normal industrial businesses, you can purchase raw materials, you can make an assumption, you know pretty much what the volume of raw materials you require, and you can make assumptions on the price. Whereas with a mine, things are different. Let me give you a short little mind experiment, Carel. Someone comes up to you, I come up to you and I say, there's a 1 hectare warehouse, and it's packed with gold Krugerrand coins. Now, I know that in that warehouse there are a couple of million gold Krugerrand coins, but amongst the gold Krugerrand coins there are several million forgeries. What are you going to be prepared to pay me for purchasing the warehouse from me? What are your considerations?
I think you watched too many movies there. I remember watching Frodo in his chamber full of coins. Dennis, what do you say? Half of those coins are rubbish. So, what do you do there?
Yeah. Well, your point is you don't know what's in there until such time as you're allowed to go in, and it's going to take way too long to go through and pile them all up and decide what's fake and what's not. So what you do is you get into sampling. And if you go in there and you grab a handful of coins and 7 are gold and 3 are not gold, would you be prepared to pay me, base the value on a 70% full value of it with a handful of coins?
You know, as miners, sometimes we're a little bit stupid, so we will exclude that. But I would probably be a little bit nervous to pay you that amount of money.
Yeah. So you'd ask and you'd insist that you could do some more work around it and more evaluation around it. And that's really what exploration is. It's taking this unknown asset or fundamental raw material asset and going and doing exploration. And through the process of drilling, of analyzing, of spatially analyzing and geostatistically analyzing the results, the geologist and the geostatistician can get an idea of what the potential ore body looks like and what the potential metal content of the ore body is. And through further work, which is defined, the geologist starts putting together what are called resources, apologies. So in the resources, and it is stipulated through international codes, the resources are classified. And early exploration, the geologist can hazard a guess, can say, potentially we've got a certain area of mineralization of a certain grade, but that's akin to the few coins. The more work that's done, the area gets sorted out a bit more, and the mineralization and knowledge of the mineralization gets sorted out a bit more. Until such time as it can be a declared resource.
You know, you sound like a geologist.
Yeah.
We're talking to people that are doing modeling, so could you rather go to the modeling site and tell us how you're going to model it?
Well, this is very important because you've got to. What happened in the late 80s, there was a scandal called the Bre-X scandal, which a company was salting their deposit in the Philippines, and it was found that investors, it became a very, very popular share to invest in. The price skyrocketed, and then it was discovered that they'd been salting. Subsequent to that, the main mining companies in the world have put together codes, and there are 3 key main accepted codes globally. There's the JORC code in Australia, JORC Geological Code. There's the 43101 CIM code in Canada, and there's the SAMREC code in South Africa. And what I have on the screen here is the SAMREC code, and there are 2 halves to it. It's the resource half on the left-hand side, and it's an increase of confidence, increasing level of geoscientific knowledge and confidence going from the initial exploration results through mineral resources, through 3 categories of mineral resources: inferred, indicated, and measured. And that is as the exploration is done a bit more. Once the competent person or the competent geologist under the code is able to declare indicated or measured resources over there and over there, those are then able to be converted into what are called mineral reserves under the code. And the mineral reserves take into the consideration of mining, metallurgical, economic, marketing, legal, environmental, social, government, and any other potential factor which may influence the deposit. And that resource indicated or measured is able to be, under the code, converted into 2 categories or levels of reserve. And we spoke earlier about pre-feasibility and feasibility studies. They are normally based on probable and proved reserves.
Now, this fits nicely to that graph that you had earlier on.
That's right. So as we're going through there, getting the higher confidence, we're getting to the valuation of these things. There's a code allied to the geological code in the 3 jurisdictions, and those are called the valuation codes. Now in South Africa, it's SAMVAL, Australia, VALMIN, and in Canada, CIMVAL. And those codes prescribe 3 valuation methodologies which can be used for any mineral asset. The first valuation methodology is the historical cost valuation methodology. That basically says that the value of an asset is the historical value placed on what you'd spent on it previously, less any degradation of the asset, and adding in any potential warranted future expenditure. That's the terminology in the code, a warranted future expenditure. Now we can take another equivalent, and that's the purchase of a second-hand car. If you're looking at a 3-year-old second-hand car, you can see what the original purchase price was for it. You can see how many kilometers it's done, how much it has depreciated or degraded. You can see what improvements have been made, whether a sound system had been put in, or whether fenders have been upgraded, bull bars and that kind of thing. And you can put an offer based on the historical cost and improvements on that asset. And that is an accepted approach in the mineral world.
I don't like your car, which you're adding bull bars and things like that. I don't think you're actually adding value to this. That's what we're supposed to do. I quite understand the process that you're explaining here in terms of the historical things. I mean, I was looking at buying a cottage in the bush, and the guy said to me, well, if I can just make my money back, that I put in it. So that is, I suppose, it's an example of a historical cost example.
That is a fixed.
It is one. But on the other side, I don't actually like your example of the car too much, because my dad bought a fancy SLK Merc in the 1960s or 1950s.
Sure.
Now you've depreciated everything all the way through, and you polished it and all of those things. According to your calculation, that thing will be worth nothing. So how now? What do you do? How does this go through an ore body?
Well, you were asked to turn your cell phone on.
I don't know how. I must have switched it on by accident. Sorry.
That comes us to the second method of valuation, Carel, and you did right there. If there is a market for 1950s SLK Mercedes-Benzes, which undoubtedly there is, and an open market and a transactable market, we can do what's called the market value. Market comparable valuations, where we say that those Mercs have been trading for 2 to 3 million rands or $1 million, and you can you wish
there are not too many 1950 Mercs around. Probably. How do you know your comparison is actually fair?
Yeah.
That you're doing, is it apples with pears, or?
Well, that is the difficulty. It's very rare that you can find in a mining or a mineral context a mineral resource which is even approaching close similarity to another mineral resource, maybe on contiguous properties with the same mineralization, with not too much geological disturbances and that kind of thing. You can say that adjacent property can give a solid indication. But I would caution valuators not to throw the baby out with the bathwater and say, well, there aren't any comparables, so we're taking this one comparable and that's going to be our comparable, because there are a myriad of factors affecting a transaction. It's the time of the transaction, it's where in the commodity cycle it was, it's whether there are any side deals going on, which is unknown, known in the published information. So what I would recommend is to try and get as large a sample as possible. Have a look at them, have a look at the comparability, maybe do some adjustments. So if, for example, you're doing gold operations, try and get as large a sample together, do adjustments for point in the commodity cycle, maybe weight certain transactions because they are more appropriate, less appropriate, and then get a range of values. And you'll get a small value and you'll get a high value, and you're likely to get a broad range. But going through that process will get the valuator a good feel of where the market is valuing these certain types of assets. And also the law of averages, or the central limit theorem, says that the more you have, the more accurate your ultimate mean or mode is going to be. So that's what I would suggest from the market valuation approach. Then let's just go back to the geological categorizations, and let's have a look at market value and historical cost value and what's appropriate under the and this is the SAMREC code. On the left-hand side, we have the let me just get it up so I can do a drawing on it. On the left-hand side, we have the approaches. We've spoken about cost, we've spoken about market, and at the top there's cash flow, and that's what the main topic of the rest of our discussion is going to be, and we'll discuss it. But the market and the cost approaches, and on the top we have exploration properties, development properties, production properties, going down to dormant and closed properties. We have a look on the bottom. Cost approach is quite widely used for exploration properties, i.e. you want to raise capital to go and do some more drilling, you've spent so much, you think it's going to cost a bit more or twice as much, you go and try and raise capital on it based on the results that you've got so far in the exploration. The rest of the stages of the project development cycle don't really use the cost approach. It's basically the cash flow approach and the market approach, which are widely used across the project development cycle. And having said that, we've discussed the market approach and the cost approach, and let's move on to the cash flow approach.
Before you do that, can I just make a comment or two on this, please, Dennis?
Certainly.
You know, whenever I've used this methodologies, I was always open to a lot of criticism. You know, people saying, "But this is inaccurate." You know, and I think especially engineers, you know, they like everything perfectly in boxes and nicely sorted out. I think people need to understand.
Yeah.
Okay. They say what's obscure is seldom clear. There is no good answer. Okay, so you must understand that when you put this thing together, you are not going to get a much better answer. I think it's better to do a good guess than to ignore it altogether. So I would support these methods, but it needs some wisdom in the interpretation as well. Keynes, also my favorite economist, said it's better to be approximately right than to be precisely wrong.
Yes.
You know, so beware, if you're going to use this method, you might be open to criticism. So, and fear not. There isn't actually anything better, as far as I know, to do the evaluation. Can we move to this cash flows? Because I believe in cash flows. When can we start using cash flows?
We can start using cash flows once we have. We can start using cash flows anytime. You can start using cash flows before you've even sunk a hole, to give some kind of indication to the geologists on what sort of tons and grades they're looking at. But in terms of the codes, you are only allowed to report results of cash flows under the South African and the Australian codes once you have a measured or an indicated resource, i.e. you have a converted reserve and it has been proven to be economic. Under the Canadian code, one is allowed to publish something called a preliminary economic assessment, which I think maybe somewhat akin to your pie in the sky example, that you've got some preliminary geological results, you have not been able to convert it into an accepted, measured, or indicated resource, but you put a cash flow to it, and very broad brush assumptions, and those are commonly used, and quite commonly you find that the value of a company decreases after the publication of a PEA, even though the PEA is very positive, because one knows that the cash flow is being looked at in a PEA with rose-tinted glasses.
Okay. Shall I talk a bit about what
DCFs.
I've learned, DCFs?
Yeah, the pitfalls and difficulties of doing DCFs. Now, Carel, what do you think are the key considerations in developing a DCF?
Firstly, DCF is actually very important in my life. I think that is all my passion and everything is sits around DCF, putting a value to it. But I was also saying that says a DCF to some people is like a hammer is for a baby. For a baby with a hammer, everything looks like a nail. So you can't actually use DCFs to resolve all your problems. It isn't the total miracle answer to everything. You actually need to actually understand what goes with it. Then there's my experience in looking at all these projects, and I've seen some very good examples of people doing extremely well, and I've seen some ludicrous high levels of detail or in projects where we have no information. So we have no information, and people looking at inventory levels of stock in their models and so forth, but the ore body could be double the size, so those things actually don't have detail. So I think what's very important here is your level of detail that you have must determine the quality of your model. And maybe not the quality, but the amount of detail in your model. So maybe a 50-line model is good enough for a concept study or a desktop study, and you're probably not going to get away with a 50-line model when you've got an existing business. Okay, and this is where modeling your intelligence needs to come in, is horses for courses. What is appropriate in terms of the decisions that you want to make? Is the model helping you to make the decisions? In other words, the options that you want to test, can you test them? Or is it this cumbersome financial model where you've got to work on your balance sheets and income statements and all of that when you actually want to test the size of the trucks of the tires, type of thing. So beware, a financial model that you use for an existing operation is not a techno-economic model. Yeah. And the techno-economic, I just want to explain the term is you look at the techno as well as the economic side of it. We bring those two worlds, the technical world and the financial world, you bring them together. And that is, to me, where the secrets of success would lie in a big project, is developing a techno-economic model. And that techno-economic model would be very different for a concept study. I mean, because concept study, you guess it and I guess it for a check. That's more or less the sort of accuracy that you're working with. Where in a pre-feasibility study, you've got multiple options that you want to go through, and you want a model that's quick and fast, that you can actually evaluate all these options. What I've seen many times, the guy said, well, we actually don't have a modeler on our team, so we've already eliminated 80% of the options, so that we only have to build models for the other 20%. I think it's a fatally flawed thinking process, because you don't know what the opportunities are, and if you want to make decisions, especially if you're going to make a multi-billion-dollar decision, you better be prepared for the decision that you make. You can't make it off the back of your of a cigarette box. I know we're not allowed to smoke anymore, so back of what I don't know what it is to use anymore. Okay, now
back of an e-cigarette box.
On an e-cigarette box. Oh, I saw you've got one of those things. I think they're quite disgusting. Personally, sorry, Dennis, I'm not supposed to give you a hard time here. The other problem which I've seen in terms of modeling is people built this model for this project, but in reality, often it's a greenfields project where your existing operation has a huge impact on the decision that you take forward. So you actually need to build a model for what happens if I don't do anything, and then what happens if I do the adjustment that I want to the operation. And both sets of thinking needs to go through exactly the same rigor of thinking. Okay. What I often found is people do this new model with a great amount of detail, but then they just assume somebody else's plan as the do-nothing plan. So that increment is, even though the new line is perfectly calculated, the line at the bottom that you're going to subtract it can actually move. So your increment could be affected enormously.
Yeah.
So that's a major flaw. And the guy says, well, it's not my domain to actually come up with this valuation. Okay.
Yeah, I just want to interject here. I find that a big problem, that a project model has got everything in it, bells and whistles. You never have that base case to the same to the same detail, and that the real value of the project is the difference between the project, the all-in project case, and the base case, and that is often overlooked.
There's one good fortune that comes with that normally is people are optimistic by nature. So they predict, they do nothing case, they predict that things are going to go well into the future.
Yeah.
But when you start to apply rigor to that thinking, you'll find, oh my dear, I have to replace the equipment much faster than what it is, you know. So they often overstate their do nothing case, which means when you fix it, the increment is bigger.
Yeah.
So often when you point out to people and say, hey, this was a problem that you get, and they get with a better answer, then they feel good about the project now looks more robust. Okay. But I wonder how many decisions we've made where we under-described the value to the project because we were too optimistic with the do-nothing case, you know. Maybe we've walked away from decisions. That's why it's so important that when you do modeling, you need to actually understand what you are doing.
Yeah, and that's something which I want to know what person can encapsulate or model all of the assumptions and understand all of the assumptions that go into a mining project. Should a modeler understand the geology, the mining engineering, the process engineering, the social implications, the environmental engineering, the legal implications, the political implications? What type of person can do all of that, as well as the economic and price and those kinds of things?
Must I exclude you and I?
Yeah.
I actually, to be quite honest, I don't know if anybody like that exists, Dennis. Some people are probably better at with a couple of years of experience, and some people are actually smarter and have an interest in other domains as well. So, to me, it's not, the evaluation process is not about one person. It's about an interactive team, and the person who's going to do the modeling brings to the table the technical skills in terms of modeling, the understanding of the financial world, and so forth. You know, when the first projects that I looked at, there was a technical document was given to you, and the financial model was given to you. And often when you read the financial document, you see in a technical document, but the production profiles are not the same. Mm. So there was a huge dislocation between what the technocrats and the bean counters.
You know, you find these alchemist models that are creating metal out of nothing.
Yes, I tell you what, it wasn't a bad thing because it gave me a career. Because I was now becoming the bridge between these two domains, and I saw the value of bringing these two worlds together. So what I want to see is actually these two worlds merging at the end of the day. So just having a modeler without any technical background, I think, is dangerous. Mm. Okay. Having somebody that's been taught about wheel sizes and the size of nuts and those things to give him a financial model is probably equally dangerous. So I'm not sure which is the correct way of doing it, Dennis. So I think my solution is if we can have the two teams working together.
All members of the team being modelers or understanding modeling.
That team needs financial savvy to some extent. And if you have a team with just technical savvy, forget it. You're not going to actually come up with a good solution. And I often also found that people come to us with projects and they say, we've completed the pre-feasibility study. There's a document you can read through. That's so long, happy. Unfortunately, we have not done the financial models yet. So we're still in the process. Our modeler was quite late. So the first thought that comes up in my head is, how on earth did you measure optimality if the tool that you need to measure optimality is not there? So immediately I knew to start digging into that project, and that's where you find huge gaps in it.
That leaps of technical assumptions not based on business principles.
Yes, yeah. So I see it, my choice would be that the leader of the team should actually be the guy that can do the modeling, so that he has the capacity to test everything that is driving his team.
Or she.
Or she. Okay. Sorry, Dennis. You got me back for the cigarette thing of yours. Okay, so if you don't have a leader that can do the modeling, at least whoever is doing the modeling, driving that process, be very close to that guy to actually help him, or that lady, to help her in making the
Okay, you can
right
say
decision.
he from now on. We'll just have that up front.
Okay. That's what I think, Dennis.
Yeah, and you mentioned earlier on of being able to use your model to measure risk. Now, mining's one of the riskiest business around. You don't know what's down there until you dig it up, and that's just the first of the problems. How do we encapsulate or cope with risk in a financial model or a techno-economic model?
Sure. There's many a slip between the cup and the lip, they say. Eh? And Dennis, there's two sides of risk. The one is actually doing things incorrectly, wrong, errors. And that I found many errors in valuations. The incremental thing that we spoke about. And that's often you find missing components in the model as well. People didn't actually account for a certain part of the processing that needs to go through. And that makes enormous differences. Time value of money differences, errors as well. I've seen one project that probably shouldn't have gone ahead because they miscalculated the tax because they got the time value of money incorrect. And they had real numbers versus nominal numbers in the same sort of thing.
That's the subject of an ebook of
all on its own
coming up
yes.
for
but the
financial modeling.
The guys go to university for that. So
yep.
We're not going to cover that. We're not smart enough to cover that in the first place. Okay. But let's talk about the risk in itself. I remember in the initial years when I started with valuations, that risk didn't feature in the decision-making process. The big boss, all he had to answer is, what is your project's IRR? And you say 15%, and you say, what is the hurdle rate? And you say it's 12%. So he says, yes, the project exceeds the hurdle rate, so let's invest. Okay. To me, you don't need to be very smart to make that decision. Unfortunately, some of these projects failed. And so people started asking questions about risk. And I think with the King report a couple of years ago, you can probably mention
Sir Bones-Oxley in the States.
Yes. We can no longer say, well, I didn't actually understand the risk, which then means you cannot say, I didn't evaluate the risk. So this is an absolute passion for me, is this integration of risk and modeling. Okay, I see you've got the book on Black Swan here behind us. Okay.
I put it up there especially for you because I know it's one of your favorites.
You should have actually had Fooled by Randomness as well. We started doing Monte Carlos a couple of years ago, and I must say a lot of the senior executives do not like Monte Carlos because I think people have done them badly. You know, there's an old saying that says, a fool with a tool is still a fool.
Yeah, garbage in, garbage
out. Yes. So you need to know what you're doing when you do Monte Carlo simulations, for example. But there's a move away from doing a deterministic valuation, which is doing it, you think all your assumptions stand still. So this is the normal way of evaluating it. And I love these two words, deterministic and stochastic. Okay.
Those are big words, Carel. But I suppose deterministic is like flipping a coin and it comes up heads, so you assume all coins are heads.
Yes. And I want to tell evaluators they must learn those two words because you quite impress the project team that you're working with when you use those words like stochastic approach or the deterministic approach. So maybe they're looking at you a little bit better. But suffice to say, if you look at a deterministic model, the only thing that you can actually guarantee with that is that you are wrong, because none of your assumptions is actually going to be perfect. Okay. Bringing in a stochastic approach, there's a couple of problems there. The first one is do I understand my variability? And then people will start arguing about the variability. And then the outcome is a 60% probability of the project beating the hurdle rate. Is that good or is it bad? You know, what is my risk appetite? I don't know whether this is very well understood in a lot of organizations. What is the risk appetite? In the olden days, when you had fantastic ore bodies right next to infrastructure with fantastic grades, with nobody around, it was easy. A fox terrier could make a decision there. Nowadays, the ore bodies are more low grade. There are people living on top of them, or they're in the wildest parts of the world, and you've got to put thousands of kilometers of infrastructure to actually get to that. It's a lot more difficult. And to me, it is better to be prepared to understand uncertainty, okay, than think you know the answer with a model like that.
So how do we go about that?
Can I just warn you a little bit about double accounting for risk in our model? You know, we used to have the discount rate of, say, 13% for a project, which included cost of capital plus a couple of other premiums that you add to it. And one of those premiums was an allowance for brownfields and greenfields projects, which was maybe a 1% or a 2%. Okay.
Yeah.
I think that could be misleading. It's probably better than nothing. I tried to get behind this. Where does this come from? I could never actually trace why a 1% was fine or a 2% was fine. Suffice to say, if you look over time and you calculate the impact on the cash flow, it might not be sufficient. So it's better than to have a semi-answer to it than ignoring it altogether. Okay. Very important point is also mitigation of risks. How far do I mitigate it? I also found that a lot of risks, people actually want to de-risk the whole project. But it's a risky business, so we need to actually make sure that we carry some of the risk that's going to make us more money. What is your risk-reward relationship?
Yeah.
Okay, so I also found when people started using Monte Carlos and so forth that they don't look at the correlated risks. For example, fuel price goes up, but explosives go down.
Yeah.
Doesn't make sense. So that to me, Dennis, is risk is actually part of your evaluation process, as far as I'm concerned.
Good. And you mentioned Monte Carlos. Other tools are sensitivity analyses, fairly rudimentary tools, scenario analyses.
Yeah. If you've put the slide up, which I really like very much. There's actually supposed to be 3 slides, but we've put it all together. So this is more or less the process of how decision making has changed over the last couple of years. Okay, so there's an evolution that we're still going through in terms of evaluating projects. First time that I looked at projects, we only had that little green block, the technical decisions, and we would take it through an evaluation, and we would then put it in a decision box, a log at the bottom. So that little orange block wasn't in existence yet. So to give you an example of that, guys would say, right, trucks, we need 100-ton trucks, 150-ton trucks, 200-ton trucks. And they would spend months debating that, which one is the best truck. And then they would make the decision, 150-ton trucks are absolutely perfect. Then they would unlock the next technical thing and often it's things that they are interested in, you know, especially the technical guys. They love to talk about size of wheels and size of trucks. So that is their natural instinct, is to go to the things that they actually like. Okay. And then we used to go through those processes for maybe 2 years. And after 2 years, we put the financial model together, and then we have this huge surprise that the project is not feasible. Well, but luckily we were smart. We then intuitively worked out what the key drivers are, and we just pull those levers a little bit until the project looked good enough. You know,
it's normally adjusting the metal price.
Yes, how did you know? The other one, which I'll tell you what your secret is, very seldom people look at the operating cost. If you want to pull that lever, operating costs, there's not enough people going to look at that. They're going to look at your capital, but not at your OPEX. Okay, so if you want to be dishonest, that's the one to. No, we don't want to teach you guys.
That's the sophisticated one.
That's it. Okay. Then we got a little bit smarter, and we said, okay, maybe we should actually evaluate it, and we included that little orange block there, the techno-economic valuation. So Now, the technical decisions were made, and we got a techno-economist to actually do a model for us. And then we see, okay, this is not actually adding value. We shouldn't be spending too much time on this. And then we move on to the next component. And then we put the decisions in the decision log. The good thing about this is many projects died an early death because they were dead horses that were being flogged here.
Yeah.
And because you had a financial model, you could actually see this thing is going nowhere, and there's nothing that we can actually do to take it forward. So that, I think, cuts a lot of effort out of our project pipelines where we spend money on unnecessary thinking. Right, and then since the King report, and with our understanding of the risks, we think that it is important that those should lead your thinking. So in other words, what we're saying is focus on the things that make a difference. Okay. Now, if you do a financial model, you have variables, like, for example, a metal price or an operating cost or a throughput or something like that. Okay, and you may have a recovery. You may have contributions to a pension fund as a variable. And not all of those things are equal. If you do a Monte Carlo simulation and out comes this tornado graph, it shows you which items has the biggest impact on your bottom line. So you can have things with a very large variability, in other words, you're quite unsure about it, and also a very big impact on your bottom line. Better that be the thing that you've put most of your effort on. Then you may have something with a very large variability, which has a small impact on the bottom line. So maybe that uncertainty is acceptable. Okay. Then you may have something with a small variability, but still a big impact on the bottom line. And maybe those are the things that you've got to take out the magnifying glass and study more. So now that you adjust your model to actually study those things in a lot more detail. And then you have things with small variability and small impact on the bottom line. Hallelujah. May we have many of those, because they have no impact. You don't have to spend too much time on it. So on the right-hand side, the variability, uncertainty, that simulations should be used to develop your schedule for your team and what they're going to spend time on in their studies. Okay. And then the other one is the risk register, which ends up as action items that you've got to do. And we're mitigating some risk. Better that money of that risk mitigation is in your financial model. Okay. Or you can actually use the financial model to see if it's worthwhile to actually spend that money on that on that mitigation factor as well. So I believe if we feed our thinking through the risk register and the financial model, we actually will focus on what makes a difference. That will help our assumptions quite a lot. Some of the risk we can do nothing about, like, for example, the metal prices.
We can hedge metal. It's going to cost. But
don't start another discussion here. Okay. And maybe if you do some tests, if you have a drop in metal prices, I mean, if you look at the moment that mines are closing down, because they're not geared for this economic climate that we are in at the moment. And some guys actually tick over quite nicely because they can go into a mode of ticking over.
Care and maintenance or low production, but that has to be built in up front.
You need to actually understand what those things are. And sometimes it's better to spend a bit more money on the projects that give you an upside opportunity. So if the metal prices go down or the market increase, that you are ready to actually maximize those opportunities. So often we found we actually increase the volumes, and by the time we set everything in place, that bull run is finished. So we don't actually get it.
Well, that brings us up to the other area, and that's optionality and bringing optionality into valuations and what the. But I think we're just about out of our specified time, yes, or our talking time. So
and we've covered everything. So my least regret, the risk-based decision-making process is, I think, where we, as people who do the valuations and modeling, can add enormous value to projects.
Right. Okay, guys, thanks for that. Hopefully you can still hear me. I thought that was really interesting, and a massive amount in there. I think we could talk for many more hours and unpack all of that. There's been a lot of questions coming in. So one question from Isabel, who's saying, You talked about the Monte Carlo simulation and why lots of senior people don't like that, and you mentioned it's been done badly. I mean, why is it not done well? I mean, is it just kind of cowboy financial modelers, or why is it? What's causing that from not being more widely adopted? Because it makes complete sense, right? As you said, the only thing that you know about your deterministic base case is that that's what's not going to happen, right? That's the only thing you can say with any certainty about it. So why is it's just cowboy modeling, or why is Monte Carlo not being more widely adopted?
Okay, there are several debates around this one, and I can take it. Let's take it from the senior executive that's got to make the decision. They get given this Monte Carlo simulation with distributions, and they don't understand all the intricacies that go into it. It's uncertainty. Okay, so it makes it difficult for them to make a decision where if they were given one number and say it's more than the hurdle rate, the decision was easy. Now you're putting a complexity to the decision. And I've often said something which was probably career limiting for me is if you don't understand the complexity, maybe you shouldn't be making the decision. So from their perspective, you bring in a level of complexity and it ends up with a lot more arguments on it. Then on the other side, from the user's perspective, who's going to use it, okay, is also where do I get the information from, And then you get the purist that says, oh, you need to have 5 years worth of exposure before you can actually use the statistic, And some people use triangular distributions and all things like that, which sometimes give you an answer good enough. Uncertainty cannot be quantified accurately. And by our nature, many engineers like that precision. So that is what makes it difficult. And then some people just don't think. I mean, I've seen one presentation where the guy said the NPV for the project is, let's say, $110 million. And they showed the distribution. They said the project the distribution was totally proud of the solution. And what I was saying is, the lowest that the project could go is $150 million, and the highest it could go is $300 million. Exactly. So their solution that they presented to the board was not even in their range.
So built in too many risks.
So now,
I think, I'll just interject here. I think as well that results are presented badly. It's the software that's available. You go and run a at-risk simulation or a crystal ball or a model risk, and you copy the statistical distributions and the graphs, and you plonk it in the report, and you say, there you go, we've got a mean, median, modian, maximum, minimum, 95% confidence interval, and there, Mr. Decision Maker or Ms. Decision Maker, go make your decision on all of these numbers. What you have to do is you have to walk the reader through. You say, this is the most likely value. It could, with reasonable confidence, go as high as this, and it could, with reasonable confidence, go as low as that. And give the decision maker just those three parameters, and they can then make a go, no-go decision, an invest, no investment decision.
Then there's another point as well, Idealist, which my first exposure to when we started doing these risk things, people were thinking, at the end of the project, they would do a risk register, and they say, okay, we've done the risk register, now all risk has disappeared. They don't disappear. They're still there. You just understand them better. And a lot of people think if you do Monte Carlos and you do some simulations, those risks are no longer there. Okay, that's not the case. You actually just understand the uncertainty a bit more. So you're actually putting a lot more uncertainty in people's heads. They were fooled by the sum of the previous decisions that they were made. So you are not popular in making it more difficult for them to make a decision.
I hope we've dealt with that one, Kenny.
No, it's good. It's really good stuff. And Beata's been commenting as you've been speaking, and she's saying one of the issues with modeling is that people often get fixated on accuracy of the model outputs to 2 or 3 decimal places, while the assumptions are correct only within plus or minus 20% margin. I think she's saying the same thing. George,
I had that criticism in a project meeting yesterday, and they very quickly threw back at me some numbers which I'd put into a few too many decimal places. So it is a trap that you can fall into.
Precisely wrong.
Yeah, exactly. So George asked that Carel speaks of least regret thinking. What about no regret thinking? Is that possible?
I don't think so. Well, I suppose it depends on what you're looking at. You know, if you have $1 million in a bank and you're going to pick a car that you want, the money has no objective, then probably you can, I suppose, go there. But with mining projects, I mean, there are many uncertainties. Okay. I've seen with one project that was overrunning its capital. We started, I think, at about 600 million, and we ended up with a capital estimate of over $1 billion. So it was very large. And we did some calculations, and we came up with a contingency because they were, every time the project team came back for more money, so we said, okay, let's increase the contingency for this project. And then we went to a 70% confidence limit, and then we went to an 80%. So the big boss said to us, he wants 100%. In other words, I read in that, no regret. So we actually had to give a contingency of $3.5 billion to the $1 billion estimate to give him 100% no regret decision. That would probably would have killed that project. Now, mining is risky, so you're going to actually end up with risk.
And the world economy is risky. At this point, we know the risk-free rate in certain countries is negative, which just indicates, risks involved in the economy.
Yeah. Guys, if I can just say, we're coming up close to 10 o'clock UK time, so we're coming close up to the hour. There's still a few questions to go through, so we're going to keep going. Those of you that need to drop off, our apologies if we're running a little bit over. We know that some of you just have an hour and need to go, but because there's still some questions coming, we're going to keep going. And if you want to come back to it, there'll be a recording, and we can send around the other stuff that we're talking about. But if I can just ask, guys, you talked earlier about the modeling team setup, and this is a really interesting point about how the modeler functions within that team. And you're saying the leader should be the team leader should be the modeler, and a couple of people have asked about that. Is that really realistic? Is that what happens? Because actually, that's not my experience, right? That the senior guy ends up doing the modeling at all. But is there a difference between needing to do the modeling or just being able to, to understand the model that's happening? Because there's so much data and so much work that the model needs to do. Is that compatible with being the team leader as well?
Okay, no, remember what I said, in my dream world, this is what I would have, the leader to have it. Unfortunately not.
The leader's got other things to do.
Their personalities tend to be slightly different as well. They tend to be more people's persons that, their interaction with people is what's important. That's how they get their success. Where modelers are often technical type of people that actually don't often like to integrate with the team.
Right, they just like to sit in a corner and gorge on data, right? That's what they want to do.
Which I think is actually a bit of a problem. Yeah. So what is the best that you can have is to have somebody that's got as much technical skills as you can get, and then integrate the rest of the team. They need to know when the guy gives a production profile to you, he needs to understand what the variability is on your model. He needs to take accountability for the numbers that's in that model. The guy that does the operating cost, he needs to actually understand that what is modeled is actually correct, because he's got something in his head in terms of fixed cost and variable cost. The modeler maybe don't have that. So that's why I say it's the model itself. You've got one person that's maybe driving it, but it's a team effort. And the engineer needs to take accountability of the numbers, engineering numbers, and the mining engineer needs to take the mining engineering accountability numbers,
Yeah.
So that is my wish. And the more technical, economic savvy there is in your team, the better you're going to perform.
In an ideal world, and I know that's being part of F1F9, and this is where FAST is trying to go, and that is creating a modeling language and collaborative modeling. In an ideal world, there would be a central financial model, and if the engineer needs to put in production schedules or needs to tweak the operating costs or something like that, they can go into the financial model and use it and see what the results are.
Yes.
They don't feel scared, and it's not the property of an individual person who hangs on to it. Yes. And this is my financial model. It's a tool that the entire team can use, and that I think is where the fast modeling standard is trying to go.
I'm going to stick my neck out a little bit here, and I'm known to stick my neck out where I shouldn't be. Often the modelers that I got accustomed to in my life are often very intelligent people. They have a huge interest in things that's happening around them, okay? And they can handle complexity in their brains, okay? And they tried, it's their nature to make this model smarter, to do more than what it actually perhaps should. But then it becomes more difficult to sell to the rest of the team, because now suddenly you're talking a language which they don't understand. It's more important for me that you have an approximate model which everybody can take accountability for, that everybody can understand. Okay, horses for courses. And if you have an operating business, maybe your model should then be 5,000 lines on 300 pages and what have you. That's what you should have. I hope we've answered that question.
Yeah, another question from Brian is asking about real option valuation. Can you say more about how that's actually used in the industry, and you know, what successors have been introducing that into the industry? Is that commonly used? We talked about cash flow. We obviously talked about deterministic versus probabilistic. What about real option valuation? How's that?
Can I go to the next question, please?
Take a pass on that one.
Webinar on it.
Sorry, Brian, you're out of luck on that one. Out of time.
I mean, what real options valuation attempts to encapsulate is that there are an infinite number of future possibilities, and to have a system whereby you can try and determine what the range is of those future possibilities. It generally is used to capture the upside of a project. So, for example, if you've got a project which is looking fairly dodgy, and let's call it early in the exploration process, and what if the price goes over a certain option value and you start getting value in it? What's the probability? What's the volatility of the price? What's the volatility of the industry? What the volatility of the costs? And option valuation, and if you're going to get into Black-Scholes modeling and that kind of thing, or if you're going to get into binomial trees, you always got to question what the underlying assumptions are. And an option valuation, if you're using a Black-Scholes model, is intrinsically based on what your assumption on volatility is. And that is a dark and a black art at the moment. So whilst there is intuitively room for options valuation, I think if we can't accept Monte Carlo simulation, or if we can't get that readily accepted as being we're looking at a whole pile of potential scenarios, looking at options valuation, I think, is going to be a lot more difficult to get accepted. I know Carel's got maybe contrary or contradictory views on it, so I'll let him go.
Yeah, because normally everything you say I disagree with.
Yeah.
Sometimes I'm proven wrong. Okay, I must say, if you have problems just selling Monte Carlos to decision makers, you're going to have a lot more problems selling options to people. Now, a criticism that I've had before is, okay, let's use an option price to put a value to an asset. So we say, how much would we be able to hedge this for? You know, if we do a hedging program on this, and you calculate that option value and say, that is the value of this asset. Immediately the boss says, okay, go and achieve that, go and sell that thing for that money. I said, no, this is a hypocritical, hypothetical valuation. So it falls flat there. And who wants to buy an asset in the first place that's been hedged out in the future? We saw in South Africa where a 10-year hedge program nearly killed a mine. So those tools are not as useful as what I would have liked it to be. Having said that, if you look at the way our evaluations has improved and is busy evolving, we originally had just one cash flow. Then we started doing scenarios, which gives you a range of uncertainty. Okay. Then we started adding Monte Carlos in it. Then we brought risk planning in, which we took certain things out. Okay. When an asset is not making profit, we close the mine early or whatever. So essentially, we're already building in optionality to a large extent in our valuations if you go for a stochastic approach.
Great. Yeah, well, guys, I think we've run to 10:05. I think that's that's enough for everybody. Just to say, if folks are on it, have more questions or want to, speak to either Dennis or Carel directly, if you go to our website, f1f9.com, you can get in touch with us through the website, or you can email support@f1f9.com. We'll make sure your questions get to Dennis or Carel. And I encourage you to take a look at our resources page on our website. Lots of ebooks, modeling resources, and so on that you can get hold of, that if you're modeling in this sector could be of use to you. So thank you to all of you who have attended and asked questions and participated during the process. And a huge thank you to Dennis and Carel for sharing their knowledge with us so freely and entertainingly this morning. It's been a real pleasure, so thank you both very much.
Great, thanks very much, Kenny, and thanks to everybody who was there.
And good luck to everybody.
Yeah.
You've got a wonderful career doing modeling.
Thanks, guys. Bye for now.